Good afternoon, everybody, and welcome to Dyke Yaxley's Autumn Budget 2021. It's great that so many of you can join us again on our Zoom webinar. Myself and my colleague Mark Bramall will be talking to you this morning about all things budget and finance and everything that you need to know in terms of yesterday's budget and spending review. So if we go on to the next slide, I'll give you a quick overview of what we're planning to cover. Thank you, Mandy. I've got pumpkin love going on here for our Halloween theme. So Mark, if you can skip a couple of slides then, please. Okay, so I'll give you an overview of what we're planning to cover. By way of introduction, I am Francesca Hutchison. I'm Tax Director at Dyke Yaxley, and I'm presented today by my colleague Mark Bramall. Together we're part of DY's advisory offering, so we oversee all sorts of planning and advisory assignments for our personal, corporate and partnership clients. I look after the tax planning side of things, so I've been involved in lots of restructures and deals in the run-up to yesterday's budget, and Mark oversees sort of corporate finance, planning and advisory for transaction type work. So today we're going to give you an overview of yesterday's budget and spending review. Mark is then going to give a national and regional economic update, talk about some of the things that he's seeing from a finance and transactions perspective going on locally and nationally as part of our tie-in with the National Corporate Finance Network. I'm going to then give you a roundup of some tax trick or treats for the last 6 months, some of the things that you might be aware of, some of the things that you might not be aware of, just to give you a flavour of what's been going on in the world of tax. And then finally, we're going to do a Q&A at the end. So can I ask, if you do have any questions, then my colleague Mel will be collating these in the Q&A box. So down at the bottom of your screen, as well as the chat option, there should be an option to post any questions, which will go directly to Mel. So if you want to put any questions in there, then Mark and I will take those at the end of this session. So next slide. If you've been to one of our budget events before, you will know that I generally like to have a theme to these. So previously I've done these with a Strictly Come Dancing theme without me dancing. We've had a Have I Got News for You theme. So in keeping with Halloween and the return to an autumn budget, I thought we would do a trick or treat theme for this budget webinar. So trick number one is 2 budgets in 1 year, and then treat number 1 is the fact that you get two DY webinars in 1 year. And my trusty colleague Mark is running the slides. It's not the ghost of PowerPoint, so we seem to be dancing around, but I'm sure we will get there in the end. So if we move on to yesterday's autumn budget, then tax lecturer Rebecca Bennyworth might be familiar to some of my colleagues who are on the Zoom, and also some of my colleagues from legal firms in practice. Rebecca is a very learned tax lecturer and well respected on the circuit, and this was her sum up of yesterday's budget. Basically, in one tweet: tax lecturer's nightmare, not a lot to talk about, a few bits and bobs tinkering around the edges, and an extension to the annual investment allowance, which will remain at £1 million. So you can be forgiven if you want to log off at this stage, because essentially that's what you need to know from yesterday's budget. But actually we've got quite a lot more that we want to talk to you about for the next 45 minutes or so. So if you want to stick around, that would be great. If not, then that's what you need to know. So on the next slide, then the cat's out of the bag. It's become the norm in recent years for a lot of the budget measures to be leaked in the press in the run-up to the actual statement itself, and that was no different with yesterday's budget. So over the weekend, we had a huge number of measures that were announced in the weekend press: infrastructure spending across the country, further support for the NHS to tackle the post-COVID backlog, further investment in skills and training to upskill the UK population and hopefully increase productivity in the UK going forward. However, I think the most interesting thing was the way in which that backfired, and there was a nod just before the budget statement started yesterday from the Deputy Speaker, and Rishi got his knuckles rapped. I think, you know, he was told that these sorts of leaks shouldn't occur going forward, that actually Parliament should be should be the first to hear of these new measures, and we shouldn't be reading about them in the press before they're heard in the House of Commons. So whether or not we will see these sorts of leaks in future ahead of any future budgets will remain to be seen, but I think that the Chancellor will have to sort of rein in his relationship with the media going forward to try and keep the Speaker happy. So in terms of the lucky escapes, the positive news from yesterday's statement, no changes to IHT or capital gains tax, that no substantial changes, and pensions tax relief again survived another budget despite speculation that higher rate pension tax relief would be withdrawn, and I think at some stage it probably will be, but we've seen it have another reprieve. The most positive measure in terms of capital gains tax was the welcome extension to the CGT reporting rules. At the moment, up until yesterday, we were in a regime where you have to report disposals or transfers of UK property within 30 days and pay any capital gains tax within 30 days. And any solicitors, conveyancing advisors or clients with property in the Zoom room will appreciate what a nightmare that's been since that was introduced 12 months ago. It's really difficult to collate the information in real time. It's even more difficult to create an online government gateway account and register to make that reporting. So yesterday, the Chancellor announced, hidden in the detail of the budget paperwork, that the 30-day reporting rule is going to be increased to 60 days, and that will take effect immediately. So I know I've spoken to one solicitor already this morning, and they were breathing a sigh of relief, and I'm sure that many of my tax team colleagues will feel the same. Now, interesting, I say there have been no changes to inheritance tax and capital gains tax, but still arguably the best and biggest tax raising measure that the Chancellor has made over the last 18 months has just been the speculation around potential capital gains tax rises. We're seeing that it's driven a huge amount of transactional and M&A activity amongst our client base and nationally. So there's a lot of deals I know that were accelerated to get over the line in anticipation of business asset disposal relief potentially being withdrawn yesterday, but it has survived. So if you meet the criteria and you have got a qualifying interest in the business, then you still have up to £1 million worth of lifetime gains that you can realise and only pay 10% tax on those gains. So a lucky escape for capital gains tax and no changes to IHT, despite the raft of technical reports that have come out from the Office of Budget Responsibility, Office for Tax Simplification, over the last 18 months or so. So if we move on to capital allowances then, and to pick up on Rebecca Bennyworth's point, the £1 million of annual investment allowance has been extended to April 2023. So that matches the super deduction, which came in the March budget and is also a temporary measure through to April 2023. Now, both of those reliefs are to encourage investment in plant, in machinery, in qualifying property refurbishments. It's to really get Britain spending and to improve productivity again in the UK. Now, the annual investment allowance, that's a welcome extension. It's not a huge surprise. There's been a lot of speculation that would be extended. The super deduction, when that was announced in the March budget, we welcomed it. It was a generous measure, but I think as time has gone on, in practice, we feel, and our clients are feeling, that it is perhaps not so super. Effectively, if you work through the maths, you spend £100,000 on qualifying plant and machinery, say, you get the 130% uplift on that expenditure. and then you're saving tax at 19%. So broadly, you're getting just about 25% tax relief on that qualifying capital expenditure, which is effectively what the rate of corporation tax will be in 2 years' time. So it's, rather than encouraging investment, I think the policy measure is to stop people putting off investment until the corporation tax rates increase and the payback period is reduced then from 2023 onwards. So it's a smoothing measure rather than a super deduction, I would say. But the positive bit of news since we spoke to you in March is that the super deduction has been extended. The original measures precluded landlords from being able to qualify for the relief due to some detail in the wording around leasing arrangements. But actually there was a late amendment to the finance bill to widen the scope of the super deduction. So it is now extended to landlords with qualifying commercial properties and qualifying capital expenditure. And just a final point on that slide, the savings from undertaking a proper capital allowances exercise can be substantial. If you're planning any significant capex on buildings, refurbishment or property acquisitions, then it is really important to get us as your advisors involved early on. The payback can be huge, and I've got a case study later on in the tax tricks and treats section. Bit of a tongue twister. So I've got a case study there later on where I will run through how those savings can be achieved in practice and where DY have had a really good win at the tribunal from a capital allowances case. So if we look at the next slide then, R&D tax relief. So there was quite a lot of discussion yesterday around innovation and investment for innovation, and within that, tweaking of the R&D tax regime, which also underpins investment in innovation in the UK. So R&D has been around for a long time now, and it's a hugely valuable tax relief which follows the principle of the super deduction I mentioned in the previous slide. So for every £100,000, for example, that a qualifying SME spends on qualifying R&D activity, they would be entitled to a further 130% deduction against their taxable profits. And if they haven't got taxable profits for that period, then they can surrender those R&D losses and get an R&D repayment. So you can get cash back from the government. Effectively, it's a grant funding arrangement, but you don't get the money until you've spent it, rather than a normal grant per se, where you get the money before you spend. Now, we see a huge number of R&D claims within the practice. It's not just software and big pharma companies that are claiming. Pharma as in PHARMA, not pharma Giles, because there are equally valid claims to be made across agriculture, food, manufacturing, a huge number of sectors where we're preparing claims and securing valuable repayments for our clients. And if you look at the UK as a whole, HMRC stats are always generally about a year out of date. So the latest available information that I've got is that over 86,000 R&D claims were lodged in 2019 to 2020. And that's a total of 7.4 billion of tax relief being claimed by those companies. Now, the interaction with Patent Box is worth mentioning as well, particularly as the corporation tax rate is due to rise in 2023. So Patent Box is a corporation tax reducer. So if you incur R&D on developing a product, and then you go on to get a qualifying patent for that product so that you protect the IP, any sales of that patented product can potentially be eligible for a lower rate of corporation tax. So it hasn't been so prevalent recently, or certainly in the last few years, I would say, because with corporation tax being low, clients have been less inclined to spend quite a lot of money on acquiring a valid patent and also defending that patent if necessary. But I think going forward, as corporation tax rates rise to 25%, there's going to be more justification for incurring the legal and professional costs to secure the IP protection, because actually you'll get your payback in a reduced rate of corporation tax going forward. So that's kind of a general overview on R&D, but a few things worth noting in terms of R&D changes and things that were mentioned in the budget yesterday. So from April 2021, new rules came in which effectively cap the amount of repayment that can be received based on the qualifying company's PAYE and national insurance contributions for the same period. So the effect of that will be felt by smaller startups or SMEs with a relatively low or no payroll costs in the year that they're making the claim, or in a group situation, if there's group recharges between a company and one company in the group incurs the payroll centrally, and the company undertaking the R&D just has a recharge of those group payroll costs, you then will not satisfy the PAYE or NIC cap as a company, so you might see a limit on the repayment you can claim. Now, it's important to note it's not a limit on the relief you can claim, it's just if you are in that loss-making position and you want to surrender those losses for a repayment. So those are changes that happened post-budget in March. Now, in terms of yesterday's budget, there was a welcome announcement that the relief will be expanded to include cloud computing and data costs. But going forward, the scope of R&D relief is going to be narrowed. So the cost that you can claim is going to be limited to the investment that you've made in the UK. So from 2023 onwards, any investment by a UK company that is made outside the UK in terms of the costs that are incurred will no longer qualify for that enhanced tax relief. So if you are part of a multinational operation, or indeed if you're a UK business with employees or contractors working globally for you, then that could potentially have an adverse impact. And also hidden in the small print we picked up last night that there are plans to tackle perceived abuse and improve compliance of the R&D tax rules. And the government have said that there will be an announcement later this autumn, so imminently, in terms of what that's going to entail. I think moving on then from R&D, business rates, always hugely topical when we do these presentations. A lot of high street businesses, property-backed businesses who have really suffered over the last 18 months in the pandemic have been lobbying for substantial reform of the business rates system. Now, yesterday's announcement stopped short of a fundamental reform, but there were some sweeteners for property-backed businesses. And I think, you know, if you work through the numbers, the government have said that it's worth up to £7 billion in what I would call selective cuts for business rates. So for the retail and hospitality sector, arguably the worst affected by the COVID pandemic, there's going to be a temporary 50% discount capped at £110,000 worth of relief in that sector. There's also going to be a new investment relief for people who are making investments into the property that they are trading out of. So effectively, an increase in business rates won't kick in for 12 months after those refurbishments have taken place. So that might be a hotel adding extra bedrooms, or a shop undergoing a substantial refurbishment, or restaurant refurbishment, etc. The planned increase in the multiplier for business rates has been cancelled. Again, very welcome news. But the sting in the tail is that we are going to be moving towards more frequent evaluations, so every 3 years, which will be welcome news to the valuers, I'm sure, but probably less so for those businesses that are having to undertake the admin and go through that process more regularly, particularly if it results in an increase in the rates that they're paying. Now, alcohol duty. That took up a large chunk of yesterday's budget announcements. So effectively, we have been working with a very outdated and very complex system for calculating alcohol duty in this country. And yesterday, Mr. Sunak announced that we are going to be reforming that. And it's going to come down to a very, very simple system of the stronger the drink, the higher the rate of tax. Again, that's further support for the hospitality sector, and the big winners are going to be the sparkling wine producers, as that's no longer going to be regarded as the most luxury item of drink. and big relief for craft beer producers as well. Taxes on red wine, sherry and port are likely to increase. However, the planned increase in alcohol duty has been cancelled, and Rishi has put that down to being a Brexit bonus. Effectively, now we are out of the EU, we have the freedom to set these rates ourselves within the UK. So it's a bit of a vote winner that to overhaul the system, make it fit for purpose, and also throw out a few bonuses there for some of the drinks producers in the UK. Transport and travel, again, featured quite heavily yesterday, not just in terms of spending and infrastructure. We've got the fuel duty freeze for petrol, a post-Brexit reform to the tonnage tax system, and the return of the red flag for shipping. Air passenger duty for domestic flights is set to fall, and to compensate for that, they're going to bring in a new extra long haul air passenger duty for flights over 5,500 miles. Interesting timing given the climate change summit in Glasgow that's about to take place, and not likely to sit well with climate change advocates. But it is still some welcome support for UK regional airports who have understandably struggled over the last 18 months or so. Plastic packaging tax. This isn't new and it wasn't mentioned yesterday, but it is coming in from April 2022. So I think it's worth a mention alongside some of the budget announcements. It's a nasty tax, this, and I'm having a lot more discussions with clients about it as weeks and months go on this year. Effectively, any businesses that import or manufacture plastic packaging that doesn't contain at least 30% recycled plastic are going to be affected by this measure that comes in next year. Now, there's a threshold of 10 metric tons. So if you don't exceed that limit, you're not going to be subject to the new plastic packaging tax, but you are still going to be expected to keep sufficient evidence to show that you are below that limit. So it's going to be another huge administrative burden for the manufacturing sector. I've seen already that it's driving some R&D in the packaging area. I've got some clients who are looking to develop new, more environmentally friendly packaging on the back of this to reduce their own packaging tax, but also as a positive sales measure in terms of attracting customers for them. However, I think it's a reminder that we need to look at supply chains, and if you are in the manufacturing sector, then it's something that you need to have on your radar and be looking at and be thinking about how this will impact you from next year, because given the shortage of materials and wider supply chain issues that we're seeing in the UK currently, if you're going to make changes to the way that you do business and sell your products or manufacture your packaging, then you need to be thinking about that now and not next year. On VAT, again, very little, if anything, in yesterday's budget statement, but just a brief reminder there that from April next year, we are going to be moving to a new points-based system for VAT penalties. So another overhaul of an outdated and complex penalty system, and it should hopefully make it easier for taxpayers to understand their risk profile in terms of liability for potential penalties, and also how those penalties are going to be calculated. So I won't run through the table there, but it's just a reminder that it's something that any VAT registered businesses need to have on their radar, and ensuring timely compliance and timely payment is something that we would strongly recommend. And then the last couple of slides on the budget then, a few wider support measures. There are always a few random things included in the budget statement that are worth mentioning. So for the arts, the creative arts, there's been an extension to theatre tax relief through to March 2024. Up to £2 million being invested in a new Beatles attraction in Liverpool. That comes shortly after the Liverpool docks have lost their World Heritage status, so hopefully it's a new positive attraction to boost that area. For low income families and households, really welcome news around the universal credit reform, and the taper has been very harsh for those who are in receipt of universal credit and also trying to hold down some work at the same time. So the taper is going to be reduced by about 8%. From either the 1st of December or sooner, if the government can sort that out sooner. So that would be welcome news for low income families, and a further incentive to get people working again. And then in terms of bank taxes as well, the bank levy is going to be cut to 3%. So banks will pay a corporation tax rate of 28% from 2023. So again, rather niche measures, but worth a mention as well. And then finally, a few early warning signs, if you like, in terms of things to be aware of, things that were mentioned in the small print but didn't receive any airtime in the statement itself yesterday. So as I mentioned, with R&D, the plans to tackle the perceived abuse of that system and improve R&D compliance. Now, those plans are expected to be released imminently. There are measures being considered for corporate redomiciliation. That's in simple terms, making it easier for companies to move themselves and relocate themselves to the UK. It can be difficult, compliance and administratively and tax-wise, to change your corporate domicile, the country where you are taxed effectively, where you're deemed to be headquartered. So hopefully those measures will again encourage businesses to relocate to the UK. And then the abolition of cross-border group relief, again, not likely to affect many, if any, on this call, but worth being aware of. Under our membership of the EU, we were required to accept cross-border surrender of losses for European group entities. However, with immediate effect from the budget yesterday, the EU resident companies are no longer going to be able to surrender their foreign losses as UK group relief. So just a tightening of the rules there, and increasing the scope of corporation tax in the UK itself. So finally then, on the budget, I thought it would be useful just to summarise a few of the key dates that are coming up for the remainder of 2021. Now, I appreciate some of those dates have passed. However, just a reminder that if you haven't made your payments under any PSA settlement agreements for 2020-2021, then that needed to have been done last week. Today is the last date to amend any furlough claims. I'll come on to that later in my tax tricks and treats slides. But you need to be aware of the requirement to correct any CJRS errors. We're expecting the draft finance bill to be published in November, with further details on measures that were announced yesterday. We've got a December deadline to recruit young workers under the Kickstart scheme. I'm not sure how many people in the room have had experience of that. I've heard mixed things from my clients who've taken on Kickstarters. Some have been super keen, super enthusiastic, and made a really positive impact to the businesses they've joined, and others less so, shall I say. So then we've got 31st of December date as being the last date to make or amend any COVID statutory sick pay claims. Again, the deadline for recovery loan applications is the end of the year, and end of January, as well as being tax payment and tax filing date, is also the last date to hire an apprentice and qualify for the £3,000 employer grant. So just a few dates there to be aware of if you weren't already. So that's really my roundup of yesterday's budget. I think in conclusion, it's a budget and spending review, to give it its full title. And I think yesterday we did see more on the spending review side of things than we did in terms of budget and tax raising measures. However, whilst it seemed light on content, I think there were a few pieces of welcome news in there, and a few things to be aware of and things to watch out for going forward. So a mixed bag, and yeah, be interesting to see what happens over the next couple of years in terms of future taxpayer giveaways in the run up to the 2024 election. So with that, I will hand over to Mark. As I said, Mark sort of heads up our finance, corporate finance, mergers and acquisitions, transactions team here at DY, and I work closely alongside him in terms of the tax planning for those transactions. So Mark's going to give you an overview of national and regional updates that we've seen over the last 6 months. And then finally, I'll come back and talk to you with some of the tax tricks and treats before we round up for today. Over to you, Mark.
Thanks, Francesca. Good afternoon, everybody. Good to see so many faces online today. So the National Economic View, I'm sure many of you will have seen the headlines, but the growth forecast for the current year, 2021, has been upgraded slightly. We were predicting 4%. And now forecast to 6.5%, still some way behind other developed countries. So mixed views on whether we're going in the right direction or not, or recovering quick enough. Inflation is obviously something that is of a big concern for many people. September's inflation was 3.1%, and the forecast is averaging 4% over the next 12 months. So the impact of that is really affecting the wages of people. If they don't have wage rises to keep peg with inflation, then really it's like a wage cut for many households. So big concerns and pressures there for many households, no doubt. And obviously the big cost of living for many people is continuing house price rises. Just looking back at the statistics, when we spoke in March, it was felt that stamp duty holiday had fueled house price rises. So if you remember, up to £500,000 was a stamp duty holiday. And back in March, we were reporting something like a 7% house price rise. Looking at that now, year on year to August, that's a 10% or just over 10% rise. And it was nearly 3% August versus July. So, you know, huge house price rises, and wages obviously are increasingly under pressure. In September, there were 68% more house sales this year than there were last year. Again, question marks over the stamp duty relief and how that's fueled things. So look out for October statistics. In terms of where we are now, I think if you go back to some of the economists that were speaking out towards the end of 2020, they predicted a cliff edge at some point during the course of this year. Given where we are now, that's not come yet for many businesses and not likely to in the near future. So all being well, we'll continue seeing clients do well. So locally, yeah, clients are doing well. Businesses are making excellent results, better than pre-COVID levels for many businesses. Some have had pre-COVID or post-COVID recoveries, but now still trading at levels higher than they were pre-COVID. So yeah, on the whole, the local economy is doing well. Obviously, our businesses sort of span across to the Welsh coast, North Wales, Mid Wales, Shropshire and the surrounding counties, as well as a little further afield in a few cases. But, you know, businesses are doing well and, you know, looking to drive forward. One thing that is just really evident over the pandemic in the last 18 months is how well businesses do adapt and clients making the most of opportunities, focusing on things like making sure they've got supply where other clients may not, has created opportunities. But one thing that's obviously a big concern for us, and you know, we see clients at all hours or speak to them at different times of day, and many business owners are exhausted, which is a concern. But I suppose all I can say is on a platform like this, you're not alone. Many business owners are feeling that way. It's increasingly a challenge for business owners. They're constantly on the go, having to think of things, and so it's sort of understanding those challenges and what can we do. sort of the priority of challenges is everybody seems to think staff in the main is their biggest challenge. Behind that, you've got the supply of product, the supply of materials. That's partly down to COVID, where there was shutdowns in many areas and not catching up. Brexit in the early part of the year, driver shortages. There's a whole whirlpool of challenges globally, from factory fires to pandemic and breakouts and things like that are affecting things. So there's no sort of one sort of continuing factor really. It's just many different ones, and businesses are faced with those. And then really the third one linked to product and materials is the price rises and how they manage that through. But many businesses I speak to are finding that they can pass the price increases through, but how long can you keep doing that for? How long can things keep up? It's a big question, and I don't think anybody knows the answer. And looking forward in the next sort of 6 to 12 months, nobody seems to be predicting that any of these challenges are going to get any easier. Obviously, the staffing is a longer term sort of issue for many businesses. So we continue to battle on, I think, is what many businesses are doing. So the business support that we've got at the moment, Francesca did touch on the deadlines. Government supported loans is actually the recovery loan scheme has been extended now for another 6 months. So just that one slide referred to the 31st of December. So they've actually extended that now. So applications up to the end of June next year for anybody looking for effectively the sort of follow on to CBILS and bounce back loans. Furlough, as Francesca's touched on, has now come to an end. And then we had the rates relief in the budget for some businesses. Besides that, nothing really to get too excited about for many businesses. So looking at other things that we've got on the go, as Francesca mentioned, mergers and acquisitions, sort of corporate finance deals, that's buying and selling businesses for the most part, and shareholder retirements and so on, have been very active, partly fueled by the speculation of a reduced capital sort of tax or an increased tax rates on capital disposals. So obviously nothing's come yet. That will no doubt fuel some speculation to whether we might have an announcement in March next year. So everybody will rally around again in February trying to get deals done. But it's important to sort of just state really that the UK has really become of interest again. We're seeing a lot of European businesses come into the UK looking for opportunities, lots of large organisations with significant capital sums to invest in the UK, looking for good profitable businesses where they can put money into and generate, good return on that money for shareholders. And sort of link back to my my earlier slide about clients being faced with exhaustion. I think that's fueling where we're seeing exits. Clients have got to the end of the line, taken the business as far as they can, and really looking for a way out. So, just remember, we can help you with pre-sale planning, whether it's buying or selling the business, hopefully taking the business to market and helping you find that for certain business sectors. We can assist with that side of it and guiding you through the process, which will always be a drain on your time and energy, but it's very rewarding when you get to the end. And we'd happily talk to anybody who's feeling like they want to consider what their options may be. So I'll hand you back to Francesca for our tax tricks and treats.
Thank you, Mark. And I think just to follow on from what you said there, I think ultimately we are seeing a lot of clients who are realising capital from their businesses, and some of those will be using that to fund retirement and personal capital purchases, etc. But I think we will see entrepreneurs who are wanting to reinvest and hopefully support other UK businesses, and particularly whilst interest rates are so low, and some of the tax reliefs for reinvestment in qualifying businesses and qualifying startups, those were untouched yesterday. So there are potential opportunities for people who've come out of businesses to maybe reinvest and support other growing businesses maximise their returns on the funds that they've realised as well. So thank you then. For the final section here, I wanted to talk to you about some of the tax tricks and treats. So some of the tricks, the things to watch out for that might have been announced since the last budget update that we had in March, and also the treats, some good news stories. It's Good News Thursday, so hopefully showcasing some of the good work that we've done here at DY, and also some of the positive things in terms of tax planning opportunities and tax news that you can be aware of. So trick number one, this shouldn't be a surprise, but this was announced, well, it was a surprise when it was announced back in the March budget. So we currently have a rate of corporation tax of 19% in the UK, but from April 2023, that's going to go up to a main rate of 25% for businesses with annual profits over £250,000. For businesses with taxable profits between 50,000 and 250,000, we are effectively going to be back in a marginal rate regime, which, if you've been around as long as I have, you will remember that from when we had two different rates of corporation tax in the past. Marginal rate relief is companies that are paying tax in the marginal rate band are effectively paying a higher rate of tax in that band for every £1 of additional taxable profits. So there's going to be a lot of planning that we can do and that can be done to make sure that groups of companies or standalone companies are maximising the tax relief that's available and minimising any tax that's going to fall in that marginal rate band, or indeed the main rate at 25%. So a company effectively making £100,000, no, you've gone too fast, Mark. Well, a company making £100,000 of taxable profits in the year to March 2024 is effectively going to be paying a 22.75% rate of corporation tax. And I think group companies, companies with lots of active group companies are going to need to take particular care, because these bands are going to be split between the number of active companies in the group. So if you've got a group situation currently and you don't necessarily need all of those active entities, then one of the potential tax saving opportunities might be to rationalise that group and maybe to have divisions within a singleton company, or just stick to a holding company and main trading company, holding company trade co group structure. So lots of things to think about there, but 2023 is creeping up on us and will be here before we know it. So it's time to plan ahead and think about how you might be impacted by that. So that's trick number one. So treat number one is the deferral of making tax digital for income tax, which has been deferred again. Making tax digital we affectionately refer to as MTD. It can also stand for making tax difficult, as many of my tax team colleagues would attest to. So we have making tax digital for VAT currently. It was planned to be rolled out for income tax, but that is effectively going to be pushed back now until April 2024. In conjunction with this, there's an ongoing review of the basis period for income tax purposes. Any changes to basis period reform are now also not going to come into effect before April 2024, and it won't be before April 2025 for more complex partnerships. So that is good news, because it's recognising the complexity of MTD for individuals. It's not easy to get your affairs online and sort of seamless real-time reporting into HMRC systems. There's a huge amount of catch-up in terms of your software and systems for being able to make those reports online to HMRC, and effectively the burden of that sits with the taxpayer, the cost of getting your records online and the administrative and time cost of actually making those submissions. So it's a welcome deferral, and we were very relieved that some grace has been granted, but again, we can't afford to be complacent. 2024 isn't that far away if you need to think about getting all of your records onto a completely new system. If you're on a paper-based system and you need to digitize things now, you need time to get used to that system, to bring it in and to get used to using it. So again, preparing in advance is going to be key, and don't leave it until April 2024 to think about what you need to do. So if that's my Making Tax Digital treat, then my Making Tax Digital trick is the fact that Making Tax Digital for VAT, the scope of that is going to be widened effectively from April next year. So Making Tax Digital for VAT was introduced in 2019 for businesses with turnover in excess of the VAT threshold. From April of this year, the digital links, if you like, the interaction between the taxpayer and HMRC's systems were mandatory. But from April 22, this is going to apply to all VAT registered businesses, not just those in excess of the threshold. So if you are a smaller business or you have clients or contacts who are smaller VAT registered businesses, then they need to be taking steps to prepare for this, because they can, if they wish to, register earlier than this. But they must ensure that their software is compatible with the Making Tax Digital requirements. So it is an administrative burden, and it is a nasty thing to get used to. But once you're up and running, our clients do find the process can be quite efficient, albeit HMRC has access to data and tax sooner than they would otherwise do. So continuing with the theme of tax tricks, my next one is the end of furlough. So the furlough scheme was a fantastic initiative to support businesses and to support employees through the pandemic, with the employer effectively being able to continue paying the wages of their employees and being able to reclaim that money from the government. So a state-sponsored support system, if you like, for employment. However, despite being extended several times during the course of the last 18 months, the system finally closed on the 30th of September. Any September claims needed to be made by the 14th of October, and any amendments must be made by today. So once you come off this webinar, if you think you need to make any amendments, then you need to go away and do so. So that leads me on to my second tax treat. So we've got the number there, £8,796,420. To put that in context, that is the value of the coronavirus job retention scheme furlough payments that has been claimed by the DY payroll team on behalf of more than 200 of our clients over the last 18 months. It is a huge sum of money, and I don't underestimate the amount of work and pain that our payroll team and others who have been dragged in to support the payroll team have had to endure over that period. But it really is one of those good news stories, I think, to really appreciate the amount of, the number of mortgages we've been able to support, the number of families that we've been able to support, and just the size and scale of that scheme in terms of, keeping the country going during a very difficult 18 months. So Rich and the payroll team, I suspect they're not watching this webinar because they will be busy doing month-end payroll, but a huge congratulations to them, and their efforts are greatly appreciated by the directors and by our clients as well. So continuing with good news, we've got our happy young Boris there. So for my tax treat number 3, I wanted to talk to you about a recent win at the tribunal for one of DY's farming clients. It was a capital allowances case, which I mentioned capital allowances earlier when I was talking about the budget slides. So in the next couple of slides, I am going to run through background and the result that we achieved for our client in that case. So a couple more random pictures for you. I'd like you to look at this and have a little think, what is it, first of all? And then secondly, when you're looking at this, do you see a building or do you see plant and machinery? The distinction between the two is key when it comes to capital allowances. Buildings generally don't qualify for capital allowances, but if it's an item of plant, so a piece of machinery that does something, that has a function, then it would qualify for tax relief. So if we get into the nitty-gritty, like I say, the general rule is buildings don't qualify unless they appear on List C. List C is a nice bit of tax legislation for capital allowances. So if it's a building and it's either a cold store or a grain silo, then under list C, the cost of that building could qualify for capital allowances and for tax relief. If it's not, then the default position is that buildings don't get tax relief. Bearing in mind that that unit that I just showed you the pictures of cost upwards of £300,000 to construct, and our client in that case has maybe 4 or 5 of those with others in the pipeline. The building is actually, it's a potato store, for potatoes being used in the crisp industry, crisp sector. So they are picked and then they are stored for a period in that building, and then they are sent on for onward processing and manufacture. So in terms of thinking about functionality, if this is a piece of equipment, the question is then, did that potato store serve a function of actually doing something to the potatoes whilst they were in that unit? Now, we took the view that this was a piece of plant and machinery. It performed a function in the business, and therefore the totality of the costs of constructing that unit should be viewed as an entire piece of kit. The revenue challenged this, and a long and protracted argument over 5 years has ensued. Now, when it came to the tribunal, it ultimately ended up being a case of semantics. So a silo is defined in the English dictionary as a chamber for the temporary storage of grains or roots. So the chamber queried is a potato a root? Is 6 to 9 months, being the period of time that those potatoes were in that unit, is that temporary? If it's not a grain silo, or if it's not a silo, then is it a cold store? And if it's a cold store, does it need to be actually cold? And what does cold mean? Does cold mean sub-zero? Or, as in this case, does cold mean maintaining a desired temperature? So the technicality here, you need to appreciate how technical this argument got when it went to tribunal. But ultimately, if we move on to the next slide, it was a significant taxpayer win for our DY client. The value of the tax relief was around £50,000, and that's just for the one unit. So you multiply that across the number that they have and across our other farming and agricultural clients. It's a huge amount of tax at stake, and a really positive outcome. The original inquiry in this case was opened in June 2016. We had a virtual tribunal hearing in February and a decision in July 2021. A huge amount of advisory time, legal time involved in the case, and liaising with our clients, etc. But to take that case to tribunal has cost our client nothing. They were covered by our fee protection insurance, which we offer to all of our clients for their tax returns when we file them, whether they're corporate or individuals or partnerships. And in this case, the fee protection insurance has covered probably an amount not dissimilar to the tax at stake, around 50,000 worth of legal and professional fees. So a double win for our client, if you like. But it just shows the importance of keeping records and evidence to demonstrate what the function of a large piece of equipment or a building functioning as a piece of plant is. And although this is a very sort of whistle-stop tour of a 5-year case, it's a really important win for clients in the potato and arable farming sector, and hopefully we will be able to generate more substantial tax savings for our clients going forward, on the base when they're able to when they're proceeding with the construction of similar units going forward. So that was a really positive win for the taxpayer and a positive win for DY, and we made the tax press, and yeah, it's been reported positively, which is really good to see. So if we move on to tax trick 4, then, I mean, this isn't new, not new in the budget, but it was announced in the run-up to the budget. It's the new health and social care levy, which is going to come in from April, and effectively it's going to be a tax on an additional increase in tax on NICs and dividends. It's a 1.25% levy on both, but bear in mind that that's employer and employee national insurance, and then for the owner managed business, it's an additional tax on their drawings as well. So it was widely reported in the press, and again, you sort of know it was a surprise when it was announced, but it's not a surprise that we need to find a way to pay for the pandemic, essentially. However, I just thought I would run through a worked example here just to show the magnitude of that change for an OMB client. So in this case, if you think about a husband and wife business, they're making in excess of £250,000 of profits each year. They've got a wage bill of around £500,000, and together they take drawings of around £200,000 a year. So how is this health and social care levy going to impact them? Effectively, 15 grand's worth of extra corporation tax, because if you think back to my earlier slides, they're going to be in that main rate of corporation tax from 2023 onwards. So that's 25% instead of 19%. So £15,000 worth of extra corporation tax. In terms of the health and social care levy, it's going to be another £6.25,000 worth of extra employer national insurance contributions. Similar figure in terms of employee national insurance contributions, and on their drawings, it's going to be an extra £2,500 on their dividend tax. So if you take all of that together, post April 2023, they're going to be looking at around £30,000 worth of additional tax in terms of the health and social care levy and the additional impact of the corporation tax rate increase. So that's £30,000 is 12% of their profits potentially, if they're not much over the 250,000. So it's a huge amount of money, and again, I think we're going to see a big focus on corporation tax planning opportunities and ensuring that businesses are structured effectively and efficiently from a tax perspective to minimise the impact of those changes going forward. So yeah, so poor Boris not looking so happy at that one. So then tax treat number 4, not so much a treat as such, but what may be in store in the future. It was good to hear at the end of yesterday's budget announcement that the goal of the Chancellor is to be able to reduce taxes by the end of this Parliament. So effectively, we're going to be paying now to hopefully have some giveaways in future. Arguably, that's a political step, isn't it? You know, generally governments like to have some tax giveaways in the run up to an election, vote winning measures. So it's no surprise that we're suffering the pain now with the promise of some giveaways in future. But it's going to be a case of watch this space and see what may happen over the next 2 years in the run up to the 2024 general election. And then my tax trick number 5, finally, just to mention something that we've seen just in the last couple of weeks, really, is we've become aware that HMRC are going to start issuing what they call nudge letters for VAT. These are targeted letters, albeit they look like a blanket letter when they come out, where HMRC systems throw out sort of exception reporting, and they suspect that there may be errors in VAT returns. They are looking to send letters out to clients to just ask them to double check that the filings that they've made are correct. Now, although we haven't seen one of these VAT letters in practice, we're aware that they are starting to come out, and we saw similar letters coming out for direct taxes in 2020-21, particularly targeting R&D claims in the software sector. So if the VAT nudge letters are anything like that, it will be quite a bland letter that just says, we encourage you to check that your filings are correct. We remind you that these are the particular rules, if it's targeted at a particular sector, for example, and we ask you to correct any errors as soon as possible, or declare that the returns were free of errors when they were filed. So it's a bit of a phishing attempt from HMRC, but these letters don't just go out to anybody, they are targeted. So what we are saying to our colleagues, and we will say to our clients when we see any of these letters coming in practice, is undertake a proper review. Don't dismiss these letters as being a general phishing attempt. pay them proper attention, have a look over your records, or ask us as your advisors to look through them, and make sure that any returns are complete and correct, because you don't want a protracted HMRC inquiry if there are adjustments that need to be made. So there's a few positive things in there, and slightly more on the tricks, but very much like the budget, it's been a balanced 6 months in terms of tax breaks and tax hits. So hopefully there's something in there for everybody, and that really brings us to the end of our budget webinar. So having said that, we didn't have much to talk about, we've managed to fill an hour talking to you about tax and other finance measures. So happy now to take any questions. I'll just have a look at my messages, see if any questions have come in. Otherwise, contact details for Mark and I are on the final slide, and we will circulate a copy of the slides to everyone that's joined, and also those who weren't able to join. And the presentation's been recorded if any of you are so inclined to listen again or watch it again. And I do have to say a huge thank you to our Emily, who crafted the DY pumpkin for me at special request, to brighten up the desk for today's webinar. So thank you, Emily, for doing that. And I think I'm slightly high on pumpkin fumes now, so I will be blowing the candle out imminently. So I'll just have a look at the questions. Mark, have you seen any questions come in?
No, I think we look as though we've got off fairly lightly today. So I'd throw an open question out to the audience, whether people want to type online or send a response in later on. But we sort of feed into various sort of business advisory groups and on different panels, and be curious to hear from other businesses what else they feel that we're missing in the local area in terms of business support. We've heard of sort of different recovery schemes, but as we've touched on today, we're seeing many businesses that are doing well, and curious to hear what else businesses need to support them and hopefully flourish.
Maybe if people want to email us then with their thoughts after this, our contact details are there, like I say, are there on the slide. But yeah, we welcome views from our client base and our connectors and our colleagues as well. It helps us to feed into those groups that we are members of, and to shape local thinking and share trends. So if I wrap up then, thank you to everyone who's logged in and watched today. I hope it's been informative and maybe mildly entertaining for you at the same time. It's always nice doing these. It's nice to do them in the Zoom format, but I do really hope that by next October, which is when the next budget will be, that we will all be able to get together in person and share thoughts and ideas, and also share any news and updates from the autumn budget 2022. So take care. I hope you are all keeping well and your families are well, and thanks again for joining us, and hope to see you all soon.
Thank you all the best.
Thank you.